David, I grew up poor, so I know how to ask the right questions of people that are on I call on out in the hinterland. And one of the things I find out there is that if you look at all of their costs, and, you look at, for example, anything they buy at the grocery store, like their car insurance, their home insurance, their taxes, there's not anything they're touching right now that's not going up a lot. And they're not their wages, while they're going up a little bit, they haven't been able to keep pace with it. And so that puts a squeeze on it. And that's why you see delinquencies on auto payments, delinquencies on credit cards going higher. I don't think there's a spot for them here because
The U.S. Treasury yield climbed by 80 basis points today. We're talking 23rd of May, Thursday, about midday Eastern time, on the back of some stronger than expected economic data. And commercial real estate bond investors are losing money as well across the board. What is happening right now with the bond sector? Giving his outlook on this and the stock markets is our next guest, Ted Oakley, founder of Oxbow Advisors. Ted, always great to have you. Welcome back.
thank you, David. Good to talk with you.
Let's start by talking about market moves today on Thursday. So the services and manufacturing gauges for May came in quite strong as well. Weekly jobless claims came in today a little bit harder than expected. Claims for jobless benefits totaled 215,000 for the week ended May 18th, down 8,000 from the previous periods, upwardly revised as well. So Treasury yields spiked, like I said in the introduction. Bonds are down as a result. Are investors looking at this data as a sign that the economy is improving and on the right track towards a broader economic growth phase?
I don't know what they're looking at, David. I know if you look at if you smooth out the claims like over a 5 to 6 month period, you'll see that they're really not on the way down. They're still about where they should be, and not changing all that much. And then on if you look at PMI on services and everything, purchasing, it really, what's been happening, it's been going back and forth above 50, below 50, and every time it moves that point, people think, oh my gosh, this is the beginning of something new. I don't know enough to know whether it's the beginning of something new,
Yeah.
but I will say it's been doing that type of thing. And so hard for me to read anything into that.
What about the expectation that the Federal Reserve is now, I guess, with stronger economic data, less likely to cut rates anytime soon now?
Well, we never did think they would do, we started the year, I think it's 5 or 6 cuts. We never thought that would happen because they wouldn't have time to get those in before all the election stuff started. And I'm assuming that if we don't get something in June, that won't get anything, because if you do something, by September or something like that, then all of a sudden you look like you're political, which I don't think they want to look that way. But the other side is not much reason for them to do it right now. They don't have the numbers where they want it. That they wanted the numbers at 2, and David, you may never get to 2. Wouldn't surprise me.
Right now, they're concerned with a lot of different things, including higher unemployment as well. Let's talk about the labor market for just a couple minutes before we move back to the bond market. Now, the unemployment reading latest number stands at 3.9%. It's been slowly inching upwards. As you know, last month's payrolls, non-farm payrolls addition was significantly lower than March's number. So do you think the Fed is concerned? Well, first of all, are you concerned about any deterioration in the labor market whatsoever?
Well, it has to be deteriorating because a lot of companies are either laying off, talking about private companies too now, because since I'm involved in community bank, we see a lot of different things. But if you look at what's going on in the economy, companies that were doing, bang up business 24 months ago, not so much now. So they're letting some people go. And then I'm just finding that layoffs have been higher generally across the economy. And if you look at sectors like, well, I'll just take, you look at residential real estate building and that sort of thing, we're starting to get some inventory. And those people, they lay off quickly. And so we'll see if it happens that way. But then the commercial real estate side, see, we're getting the reverberation from those sorts of things now start to happen. And I think that's what's feeding into the economy right now.
How are small businesses feeling about economic growth prospects, business prospects, and hiring prospects? As you know, small businesses account for the large majority of the economy.
Well, I just use the National Federation of Independent Business, the NFIB. If you look at all those numbers now, granted, they'll have some months where they bump up, but generally, okay, they're on the downside, meaning that they're not that excited about that. They've got inflation problems they can't pass on. They've got problems with them, not being able to hire skilled people. There's a lot of things that factor into them, and I think small businesses right now are really in sort of a tough spot because they can't, unlike a big business, they can pass it on. They can't, it's hard for them to pass it on.
Before we continue with the interview, I want to tell you about a great resource for investors, Doug Casey's Crisis Investing newsletter. Now, as many of you may know, Doug Casey has been a regular guest on my show and is a fan favorite, which is why I'm pleased that he's decided to sponsor this message today. Now, for those of you who may not know Doug, he is a best-selling author of several books, including the New York Times best-selling book, Crisis Investing. And he's had a proven track record at spotting market opportunities, especially in beaten down sectors. Even during distress, there are still opportunities for investors, which is why Doug writes about them in detail in his Crisis Investing newsletter, which covers a wide range of assets. A recent issue of Crisis Investing focused on the uranium market, for example. Uranium was one of the top performing commodities last year and has already breached $100 per pound in January 2024. But Doug believes prices are going much higher. What sets Crisis Investing apart is that Doug recommends stocks that he likes and actually owns personally. This means you get direct insights into his thinking and how this legendary investor is growing and protecting his own wealth. Doug has agreed to give a 20% discount to viewers of the David Lynn Report. So if you'd like to know more about how Doug is investing his money, subscribe to Crisis Investing today. Just go to crisisinvesting.com/David in the link down below or scan the QR code here. Another indicator that we should talk about is the consumer sentiment index. It's been falling recently. It's been the longer term trend since 2022 has been up, but we've seen the biggest fall since the beginning of 2024. Do you know why consumers, at least the ones surveyed by the University of Michigan, are feeling less optimistic than a few months ago, Ted?
David, I grew up poor, so I know how to ask the right questions of people that are on I call on out in the hinterland. And one of the things I find out there is that if you look at all of their costs, and, you look at, for example, anything they buy at the grocery store, like their car insurance, their home insurance, their taxes, there's not anything they're touching right now that's not going up a lot. And their wages, while they're going up a little bit, they haven't been able to keep pace with it. And so that puts a squeeze on it. And that's why you see delinquencies on auto payments, delinquencies on credit cards going higher. These people can't make the numbers work. And I talk to a lot of people out there just to see what's happening with them. And, they're working 2 jobs or 3 jobs, but there comes to a point where you just can't make the numbers work. And I think that's where we are with those people right now.
Well, do you think that those people, the average middle class of America, they're going to continue struggling throughout the rest of the year due to either sustained high inflation, high rates, or just a deterioration of the economy?
I do. I don't think there's a spot for them here because if you look at what's going on with the things that are inflating, which are most of the commodities and things along that line. And funny, it's interesting about inflation. Once you start inflating, people just start adding on, adding on, adding on, with the assumption they can always say to the customer, "Well, I have to do it because my cost went up," and things just keep on multiplying. And my idea is that will have a problem for people in the lower 50% of income.
Do you think then that the economy will lag because of that? On the other hand of the argument, the other side of the argument, rather, is that the wealthy, the top 10% or 5%, their net wealth is still correlated with, I guess, equity markets and other markets as well. And that's been going up. And if their net wealth is going up, they're still spending money. That's going to drive consumer demand in the economy as well. That's going to basically offset any lag in spending from the middle class.
Well, it does to a degree. I think, again, one of the problems you have in the country is that all of this the Federal Reserve has done the last 20 years has been great for people with a lot of money, but it's been horrible for everybody else. And, you've got this situation now. And I think what they've run into now, though, and you're going to see this show up, is that all of this asset appreciation, it's one thing to have your stock portfolio go up. But if all your real estate goes up and then the smaller people trying to buy real estate, see, that changes that game. They're not, they have to live in a house. They don't have to live in the stock market. And so all of that fits in together, to me at least, to see what's going to happen in the future. And I just see slow growth. I mean, I can't imagine you're not going to stagflate here
Hmm.
and maybe grow at, I don't know, 1.7, 1.8, 1.9%. That's about all you're going to get.
Okay, well, let's go back to the yields and finish off on the treasuries before moving on. So the TLT, for example, it's the 20-year ETF. It's had a tough year, going from 100 earlier the year to now something like 90, $91 a share. How are you feeling about treasuries right now? Do you still like treasuries as an asset class?
We do. All three of our strategies have a very high amount of treasuries. Now, obviously, the conservative income and high income have more than the stock account. But most of our treasuries are less than 2 years. We're getting over five on everything. Every time we get the 2 year up to about 5% or over, we reach out and buy a few percentage points of it so we can stay locked in on it. We don't really own, we haven't really bought the long maturity. I know a lot of people are thinking we want to buy the 20-year bond like the tilt or something. But if you stop and think about it, if you're only getting 4.5, and let's say the market does move, say you move a point, and you make a one time maybe 6 or 7%, you see the risk of that and the cash flow is not worth that move. I think Wall Street's still selling it, but I don't think that's the way to go as long as you can get the rates to where they are today, I think.
So just so I understand, you're staying shorter duration because the risk return profile is better there?
Well, we think it is. Naturally, if rates go down a point, let's say that people, you're at a 5.5 Fed funds rate. Let's say the Fed funds rate goes down a point and a half. So you go to 4% on the Fed funds. If I buy I go out and buy the 20 or 30-year treasury and I get 460, let's say, or 465, that's not enough spread for us to say, okay, we really want to do that. If rates were really high, and we thought you'd get a break of 3 or 4 points, that's one thing. But where they are today, it doesn't make sense to us, at least, to do long duration.
But if the Fed funds rate does go down later on in the year, would you allocate assets differently?
I don't think so, because I don't think they can drop, if you take it at 5.5, and people, I don't think people realize, but normally your 90-day treasury is going to be around Fed funds. It won't be quite as much, but it'll be around there. And if you look at 5.5, let's say they take it down to 4, I would be okay with short paper at 4. I'd be okay with that. I think I'd be more okay with that than risking the chance that they might not go down if I buy 20 and 30-year paper.
This story came in from Bloomberg a week and a half ago, mid-May. Beijing offloaded a total of $53.3 billion of treasuries and agency bonds combined in the first quarter, according to calculations based on the latest data from the U.S. Department of Treasury. Now, China obviously has its reasons for budgeting and why they're buying and selling treasuries, but does that particular story or event concern you?
Well, it does, because if you look at foreign purchases of treasuries, they really, if you look at when our debt went from 17 trillion, say government debt, to now 35 or almost, foreign hasn't gone up at all, zero. So that means they still have about the same amount they had in 2017. And what that tells you is they don't want it. They don't want the paper. And there's probably a lot of reasons for that go into
Hmm.
where the U.S. is. I think the U.S. has made some major missteps, but that's just personal opinion with those countries. But they just don't want the paper. That's bottom line.
Well, does foreign purchases and selling in this case impact the valuation and the price at all? Does it have any impact?
Well, that's not enough to impact it for that sale, I would say. But what does impact it is if you keep depending right now, if you look who bought paper the last 6 or 7 years, it's been our own pension funds, our own government, our own, money market fund. And that's who's bought the treasuries. Well, you get to a certain point to where the old adage you learned back in business school, crowding out, really does happen. The government, the government's getting all the money for bonds,
Sure.
and I think that's what we're in the process of right now.
Okay. If rates stay higher for longer, what does that mean for the Treasuries market? Is that good or bad, generally speaking?
That just means that people that are in trouble are going to get worse trouble. I think it'll be really hard on the banks. I think banks right now, I think private banks are having, the mid-size, the middle America banks are having a really, really hard time right now, and that's going to keep the pressure on them.
Yeah. So let's talk about corporates, CRE, and then banks as well. I'll read you a paragraph here from an article from Bloomberg. For the first time since the great financial crisis, investors in top-rated bonds backed by commercial real estate debt are getting hit with losses. Buyers of the AAA portion of a $308 million note backed by the mortgage on the 1740 Broadway building in Midtown Manhattan got less than three-quarters of their original investment back earlier this month after the loan was sold at a steep discount. It's the first such loss of a post-crisis era, according to Barclays. All five groups of lower-ranking creditors were wiped out. What's going on right now?
Well, they just can't make the numbers work, and I've always thought, and that same article, I read that same article, and a year ago, I think 15% of them couldn't make the payments. Now I think that article refers to it maybe 30, 31. I'll be surprised if in a year it's not 50 or 60 because you can't make the numbers work. And I think what's happening is that people are realizing that, and a lot of them are not marking to the market. I mean, they haven't hit the wall yet, but I think they will. And commercial real estate they just overbuilt it. Then you got into work from home, and then they're in a mess. And then that's where we are right now. And I get at least two emails a week, by the way, of commercial buildings all across the United States that are going for, 20, 30 cents on the dollar.
Well, do you think it's good value right now? Would you get in?
Not really. You'd have to have now, if you had a special building that had a certain kind of tenant that had long-term leases, you knew things were great. That's one thing. And there's some of that out there, I have to tell you, but not a lot though. And there's some of it, but not a lot. The really big office towers, they're having a tough time right now.
Well, let's talk about assets you do like and your asset allocation. So first
Yeah.
of all, you said that 60/40 in your latest quarterly report is really no more. It's more like 30/30/30/10. So you've
Uh,
got in your, for your strategy, 30% fixed short-term fixed income, which we talked about, 30% growth value equities, 30% real estate, and 10% trading.
mhm.
Let's go through these. So the
Yeah.
30%
It's
growth to
actually
value equities. Sorry, go on.
it's actually real assets, not real estate, but real
Oh,
assets,
real
like
assets. My mistake. Yeah, I misspoke
commodity.
there. Real assets. Growth value equities. What are you referring to there?
Well, one of the things we find is that, for growth, if we can buy growth at a reasonable price, Garth, we do it. That's one of the things we look for. We're looking at screening 200 to 250 companies that we think are really good companies. If they hit the numbers for us, then we'll start to add in. And we don't just jump into these things. We'll start to add a 0.5% and then 1% and add as we go along. And so that's what when we say growth value, to me, growth is value. They go hand in hand. You just have to buy the growth correctly. That's the difference. And then that's where I'm saying, and I think you will see a lot more what I call value stocks in the next 10 years where the balance sheets are really good and the debt's low. They've got high cash flow, free cash flow is good, pay good dividends. That's the sort of thing I'm talking about.
Okay, so let's clarify a little bit more for the audience. I know that you've talked about debt refinancing risk for companies. This may affect the smaller cap companies more than the large caps. The smaller ones generally are more levered on their balance sheet. And so it's also ironic because some of these smaller cap companies have traditionally been defined as more growth, right? So how do you sort of play that dichotomy here? You've got growth stocks on the one hand,
Right.
but they're also more susceptible to refinancing risk.
We don't go to that level, actually, David. We don't own the small companies. One of the things we've found is that if you'll buy the large companies right, and when I say right, when you're buying them so that you've got a number expectation over the next 5 years. That's a pretty good number in return to you. And so we look for larger companies that have that. Now, do we buy some companies in that mid-range? Yeah, but they're still large, I should say. And if we find growth companies that are really cheap, I've mentioned this before, but if you look at Amazon and Apple and Microsoft, you look at that over the last 15 or 20 years, you could have bought them 4 or 5 times. They got cheap. And that's really what I'm referring to. I think to step down and start buying a lot of small cap stocks, if you're good at it, that's one thing. That's not what we do. Uh, but they can do really well or they can do really poorly for you. So you have to really know what you're doing.
We spoke about Nvidia offline. You're not going to get in on that. I mean, that's some would argue the ultimate growth stock right now.
Well, let me say this on that. If you look at it, and I was talking to Chance Finucane, our CIO, about that too. If you look at at peak growth, then was really the fourth quarter. It was something like 265%. It wasn't that much in this quarter, even though it was really big. And if you look at what they're expecting the next quarter, I think they're down in the hundreds, which is still a good number. But see, if you get a rate of change on something like that, then you'll go through a period where, those stocks don't do, maybe they're up, but they don't do as well. For us, we're just not going to try to figure out and not sleep at night because we don't know what Nvidia is going to do this quarter. To me, that's not investing. Investing is being able to buy a company you really like at a good price, okay, and hold it for 5, 10, 15 years. That to me is true investing. To try to play Nvidia and find out what they're going to do this quarter and all that sort of thing. I know it's going on. Don't get me wrong.
Right.
That's just not what we do. We're not gonna base our returns over the next 5 years on whether we caught Nvidia at the right time.
I know you own some big tech names like Microsoft, for example. So what was your rationale for buying Microsoft when you did?
Well, we saw the next 5 to 10 years returns that would be above normal, and the free cash flow levels were up. We've owned Microsoft, for example, for 15 years, Apple for 10, but we sold them along the way too. They get expensive at times, and we cut back on them. So I don't mean to imply that we don't ever take any off, but they sort of come and go. But when we look at companies like that, we're just looking. The only one that we bought really in the last 4 months or so, we bought more Alphabet. It came back into a place where we like it, and we really think there's a lot going on there. So, we like that company, but we already own it as well. So, but it's only, again, those are just pieces of the whole puzzle. If you look at everything else we own a lot of healthcare, energy, different things.
How do you feel about cash right now? So, as you may be aware, Berkshire Hathaway's latest quarterly report revealed that in Q1 they have a record cash stockpile of $189 billion, projected to perhaps even reach $200 billion, the largest in their history. Do you think that this is just internal positioning, they're moving things around, or is there a general sentiment from Berkshire Hathaway and perhaps some other investors to stay more defensive right now?
Well, if you look at what they've done over the many years I've followed them, they typically show up when times are bad. That's when they really bring the checkbook out. And I've seen them spend a lot of money when times are bad. And it's good to watch that. They tend not to buy things when everything is at the upper end. If you just look at the numbers today, for example, the S&P is 27 times, the CAPE ratio is 34 times, or price to book is like almost 3 times. Everything's really expensive, and I can see why they wouldn't want to jump in and buy a lot of things. But I think that's a reason why. I think if it was there, they'd spend the money. I just don't think they see the value right now.
But would you move in more cash right now?
Not any more than we have, because we have in two of the three strategies, we have 50% in treasuries, and
Hmm.
and then in the stock strategy, we have about 42%, maybe
Yeah.
42 or 43% in the short-term treasury. We're making, over 5% on it. So I'll give you a statistic just so you want to know this. If you take the S&P in December of 21, okay,
Right.
which is almost 2.5 years now, right?
Right.
You take it today, okay, and go run the numbers on it. We're up about 500 points on the S&P. Throw in another 2.3 or 2.4 for the 2 years worth of dividends. You know what you end up with? You end up with about 6% return for all these people out there in 60/40, okay? And that 6%, if I'm over here making 5.25 on a treasury, why would I want to get really aggressive to try to go get that six? Does that make any sense? And
Yeah.
that's how we look at it from our standpoint.
And another way to look at it as well, if you're making 5% on treasuries, Ted, you're already beating headline CPI. So does that reduce your risk appetite? You know, why hunt for higher yield if you're already making net positive returns on risk-free assets?
You know, David, that's a great point, by the way. We look at it like that too, as well.
Yeah.
And to offset it some in all of our strategies, we own, we own gold and silver, and we own in a couple of them we own the miners too, and we own commodities. And so those two things they all fit together like that. We just think that's a better way to approach it right now.
Yeah. What is your, so I mentioned earlier, 30% real assets. What is your rationale there for holding, 30 of your portfolio in commodities and real assets?
Well, if you look at the kind of money that's been put into, there's been a lot of capex lowered, going into a lot of commodity bases. So we think that most all commodities will do better this next 10-year period. We went gone through a long period where commodities didn't do well relative to financial assets. But if you look, just go back and pull the Bloomberg Commodity Index, it'll give you a good look at it over the last 20 years. And you'll see how it really didn't perform up with financial assets. However, now we're going into periods of where we don't have as much of everything. That's the problem. When you don't have as much, and all of a sudden the prices have to go up. And I think you're going to see that all the way around. For us, we've got a big spread: fertilizer, food,
Yeah.
metals. We have oil and gas, pipelines, a lot of things that fit in that category.
Well, how do you feel about the prices of some of these assets today? Gold has reached new all-time highs. Copper has recently, just this week, reached a new all-time high. Platinum is just starting to climb. Palladium is just starting to climb. Well, oil is not doing great. But besides that, the other base metals, do you think they're a little bit too expensive now?
Well, you could always get a little selling in them. I have to say that most everything we own in those categories you just mentioned, we own lower than where they are today. Now, new money coming in will go a little bit slower because of just what you said with higher prices. Because you'll go through periods where you have a few weeks where things get softer. I don't I don't I don't think you get anything major. I mean, I could see 120 bucks maybe on gold, or 120 something, where people might think, oh man, it's over, but it's really not. We think that's something that'll continue to move forward. You have to look at what they're doing overseas. They're really buying a lot of gold overseas. I think they've lost faith in the dollar, and they're like, we're going to own something else.
Well, how do you determine if, first of all, you're absolutely right. The Chinese investors have been piling in gold. Central banks around the world have been stockpiling gold last year. But how do you determine if something like gold is overvalued or undervalued, quote unquote? You can't apply traditional valuation metrics like you would with a stock.
Well, no, you can't. You have to look though if you look, a lot of the good people I know in that business will tell you that they'll give you a pretty good idea of what your lifting costs are in mines, and relative to where the prices are. You get an idea about that. But the other side of it is, one of the things that I think people forget is that if you are in a what I consider a stagflation era, or at least an inflation era, the next 10 years, gold will they will it will stay up with that. And a lot of people use the Dow Jones to gold ratio. You look at that, and gold would still have quite a ways to go. One of the two things: either Dow would have to come down, or gold would have to go up. And I'd probably get a little bit of both in the end. But for us, we just use periods of it where there's usually, sort of like a stock, there's periods where it will fade back, and when it does, you try to pick up some of it.
So, given that your long-term outlook for inflation, I guess, is either neutral or up, how would you play that besides gold, besides commodities? Which businesses do you think are good long-term inflation hedges, or types of businesses?
Well, I know a lot of people wouldn't agree with us on this, but I think you have to go to the energy business, because you're not what's happening in the world right now. And I know people want to go green, and I do too. But the problem is this idea that we can become electric based, it just won't work when you put the numbers to it. So I think people are underestimating energy when you look at it. I think they're underestimating metals when you look at it too. And I'm just saying the supply of metals and where they come from. A lot of these countries that we don't get along with produce a lot of metals. And so you have to start to look and see where that is as well. But if you do metals, you do fertilizer, food and fertilizer really work well in inflationary environments. You have to own them, to get to that. But there's a number of things you can own in there, and then you have to look at a company or companies that have the ability to adjust prices. That's important. And so you don't buy companies that do everything long-term contracts because you're going to get hurt like that. So that's we look at buying companies where it's sort of like when you just see a job out there, it's sort of a cost plus. we want companies that price like that.
Hmm. How do you feel about consumer staples companies? So I looked into Walmart, for example. In almost every single recession since the inception of the company,
Mhm.
Walmart has outperformed that recession. Presumably, when you think about it, in an inflationary environment, box stores have the power to keep their margins afloat. The demand for their product is relatively inelastic if they keep prices low. Do you like them? Do you stay away from them?
Well, we do. I mean, Walmart's a good company, but if you look in just recently, the last couple of weeks, Walmart's talked about how they're going to price some things to try to bring more people in the store. Target is really in trouble. They're pushing those prices down. For us, we own things like that, like we own Coca-Cola, we own Kimberly-Clark, we bought just recently with the weakness, bought McDonald's, that sort of thing. We own MasterCard, Visa. They always make it no matter what, but I wouldn't have a problem with Walmart. It's just not where we would probably price it right now to buy it.
Finally, I want to talk about the 10% of your portfolio, which is labeled trading. I want to ask you what you mean by that. I'm presuming you don't mean Bitcoin trading.
Well, I don't, but I can only let me give you a great example.
Okay.
Over the years, we've owned healthcare, and over the years, we owned United Health. Uh, Sometime back a year or so ago, we sold a little bit at a high. It actually came back and we added to it again. It got into our zone where we thought it was a good buy. And recently it went up to a price where we just felt like it wasn't a good value for us anymore. And what we do with something like that is we make some adjustments to it. We'll sell that maybe, and we still want to be in that space. So maybe we buy, if you see us buy Molina or you see us buy Elevance, you'll see us buy other companies that we think have a lot of potential in the upside. When I say trading, I don't mean that we're in there trying to trade it every day like an option or a quick trade or something like that. We're trying to produce long-term capital gains for tax reasons, but that's what I mean for trading. I think, but moreover, and then this is where I want to get to, and I don't think our industry has no way of knowing how to do this. And that is, I think the next 10 years of markets will be in a zone much like they were for 15 or 16 years and then 2012, but 15, 16 years that ended in 82. And the same way 2000, 2012, they'll be in a zone and you're going to have to know when to take money off the table generally and when to put it back. And I think the industry today has no ability to do that. I don't think they grew up like that the last 15 years. And I think that's what will really throw them the next 10 years.
Well, how do you think they'll cope? By the way, you've also mentioned in one of your slides that the passive investing industry has outgrown the active investing industry. So I'm curious to see how you think the active industry will survive.
Well, again, if you just take the passive industry, I use that S&P as an example. If you just use that as an example, you could have actively beaten that by just doing a few things differently. You didn't need to do a lot, but you could own treasuries, you could own energy, you could pick up some other things and beat that 6% number that I talked about. And I think what happens though is I think people just plug in and they're living to a degree off of what happened the last 15 years. So if you bought the index, let's say 12 years ago, I'm going to use that as an example, and you look at the profit number, it's really good. The percentage is really good. So when you look at a portfolio, you feel good But if you look at your returns over the last 2 years, say 2.5 years, they're not so great. And that's sort of what happened from 2000 to 2012. We came off of that period between 94 and 2000 where people made a lot of money. And I had so many people tell me, well, I can't sell this stuff because I don't want to pay the tax on it. They should have paid some tax. And again, what I talk about trading, that's what I'm talking about.
Let's close off on this. So you're actually the author of several books. I don't know if people know this about you, but just one of the books that you've written, Your Money Mentality: How to Feel About Risk, Losses, and Gains. A couple of years ago, you wrote this. You wrote a number of other books about personal finance as well. So let's just close off on personal finance. What do you think the average consumer or investor should be prioritizing with their finances today, or due to prioritize, given the macro environment that we've discussed?
Well, I think, first of all, they should not trust their debt. In other words, by that I mean they have a lot of debt and they're feeling good because their 401k is probably up there where it's been, and that's sort of the real estate is where it's been. They're not getting any money out of it. It's just a good value to put on their balance sheet. I would not get hung up on that because without liquidity over the next 10 years, you're going to have trouble. So if I had the average investor here today, I'd say, look, no matter what you think about what's going to happen, go ahead and take a 20 to 25% minimum liquidity, put it in the treasury, make 5%, and don't try to think that this next 10 or 12, 15 years is going to be like the last 15 we had, because it's probably not. And I think it's hard to get over to people, David. I think they think it will be, and I think the street sells it that way because we've got a lot of people in this industry that have never been through really hard times. So that would be my advice to them.
Excellent. Where can we learn more about you and Oxbow Advisors?
The best place is Oxbow. You just go to our website, oxbowadvisors.com, and there's everything we do there, really. Everybody we ever talk to, what we print, what we have, like I say, a number of books there that we'd be happy to send you. So, in fact, we have a new book coming out next week called 30 Million and Broke.
Oh yeah, we've talked about that book before. Yeah,
Yeah,
one of our
it's a
prior episodes.
redo.
Yeah.
It's a redo because of inflation, and I did 15 years ago, 20 million and broke, but we've got inflation. So, by the way, I had some war stories to put in there in the last 15 years too. There's
Oh,
always war stories about people losing a lot of their money.
where can we find this book? Is that
You
online?
can get it at the website. Yeah, if you go to the website, be happy to send you a copy.
Yeah, I love to read that book too. I don't have $30 million, but I like to learn how to not be broke.
We're just going to send you one.
All right, Ted. Pleasure
Okay.
to read it and talk about it with you next time. Thanks for coming on the show today.
All right. Good to see you, David.
And thank you for watching. Don't forget to like, subscribe, and follow Ted in the links down below.